By the end of this video, you'll know exactly whether the 1% rule in real estate still works, where it's dead, where it's alive, and what to use instead. And the last method? Nobody talks about it, but it could make a mediocre deal outperform a great one. So grab something to drink and let's get into it. Here's the rule in case you haven't heard it. A rental property's monthly rent should equal at least 1% of its purchase price. Buy a $100,000 house, collect $1,000 a month. Buy a $200,000 duplex, collect $2,000. It's a 10-second gut check, a filter to stop you from spending 40 hours analyzing a deal that will never cash flow. Simple, clean, and in most US markets right now, almost completely impossible to hit. But here's the thing, it's not dead everywhere. Knowing exactly where it still lives is something you can act on today. The national median home price sits around $420,000. To hit 1%, that property needs to rent for $4,200 a month. The national median rent for a single-family home? About $1,987. That's a 0.47% ratio, less than half the threshold. In San Francisco, you're looking at 0.27%. Los Angeles, 0.35%. Austin peaked at 0.31% during its 2022 frenzy before prices softened slightly. The math doesn't work in these cities. It hasn't for years. But pull up Zillow in Cleveland, Ohio, or Indianapolis, or Memphis, Birmingham, Detroit. In these markets, you can still find properties at $80,000 to $120,000, renting for $900 to $1,200 a month, right at or above 1%. Adam Data Solutions found that only 4% of large U.S. counties still routinely produce 1% properties. That's down from 25% in 2015. The rule isn't dead. It just moved to cities that used to be punchlines. Tan Nguyen figured this out before most people were even asking the question. He's a Vietnamese-American landlord in Cleveland's Slavic Village neighborhood, and he owns 14 units across 7 properties. His rule was simple: $700 in rent for every $70,000 he paid. Every single property, no exceptions. His friends laughed at him for buying in Cleveland. Today, his portfolio is worth about $1.1 million and clears $5,000 to $6,000 a month after expenses. He never deviated from the rule. Not once. So if you're shopping in a market where median prices are above $250,000, you're fighting gravity. Redirect the search. That's the first move, and you can make it today. Okay, now here's where it gets interesting. Because even finding a 1% deal doesn't mean you're safe. A guy we'll call Marcus spent 8 months in late 2021 hunting for a 1% deal in the Charlotte market. Everything came in at 0.4 to 0.5%. He finally found a house in Gastonia, North Carolina for $185,000, renting for $1,650 a month. That's 0.89%. Close enough, he figured. He financed it at 3.25%, cash flowed about $400 a month, and thought he'd done everything right. Then the property taxes reassessed. Insurance in the Carolinas spiked 20 to 30%, a documented trend driven by weather-related risk repricing. The HVAC died, $5,200. His projected 8% cash-on-cash return dropped to around 3%. He wasn't losing money, but he wasn't winning either. And he was exhausted. Here's what Marcus missed. The 1% rule has a fatal flaw at today's interest rates. In January 2021, a 30-year mortgage sat at 2.65%. By October 2023, it hit 7.79%. That same $300,000 property went from a $970 monthly payment to $1,730. That $760 difference is enormous, and the 1% rule doesn't account for any of it. What does account for it is the DSCR, the debt service coverage ratio. It's your net operating income divided by your annual debt service. A DSCR of 1.0 means the property exactly covers its costs. You want 1.2 or higher, that's your breathing room. Dave Meyer at Bigger Pockets calls it the GPS to the 1% rules paper map. More information, same destination, far fewer wrong turns. Run this number before you run anything else. It's the difference between a property that looks good and one that actually is. If you're finding this useful, hit subscribe. I put out videos like this every week, and the best part of this one is still coming. All right, remember how I said the last method was the one nobody talks about? Here it is. The 1% rule is a gross income filter. It was never designed to account for taxes, and taxes might be the single most powerful variable in real estate investing. Here's how it works. The IRS lets you depreciate a residential rental property over 27.5 years. On a $300,000 property, that's roughly $8,700 a year in paper losses you can use to offset income, even if the property is cash flow positive. But there's a technique that goes even further called cost segregation. An engineering study reclassifies parts of the building, flooring, appliances, landscaping, from 27.5-year depreciation to 5 or 7 years. On a $400,000 property, that can generate $80,000 to $120,000 in deductions in year one alone. Think about what that means. A 0.6% property in Austin that appreciates 6% annually and throws off $80,000 in first-year tax deductions can out-earn a 1.2% property in Cleveland that appreciates 1 to 2% a year, when you model it over a 10-year hold on an after-tax basis. The Rust Belt deal looks better on the surface. The appreciation play, structured correctly with a cost segregation study and proper tax status, can quietly win the decade. Zillow learned this the brutal way. In 2021, they were buying homes algorithmically across 25 major markets: Phoenix, Atlanta, Dallas, Denver. Their own models later revealed they'd purchased approximately 66% of their inventory above resale value. They shut the program down in November 2021 and wrote off $304 million. If Zillow's algorithms couldn't make the math work at 2021 prices, that tells you something about how tight the margins actually are, and why understanding the tax layer isn't a bonus move. It's the whole game. Once you see it this way, you can't unsee it. So here's where you actually land. The 1% rule isn't dead. It's a compass, but it only works if you're pointing it in the right direction. In most major markets, it gives you false confidence. In Cleveland, Indianapolis, Memphis, it's still the best 10-second filter ever invented. Layer the DSCR calculation on top to stress test your financing. And if you're in a higher tax bracket, model the after-tax return before you ever count a deal out. The investors quietly building portfolios right now aren't arguing about whether the rule is alive or dead. They know when to use it, when to supplement it, and what it doesn't tell them. Now you do too. Share this with someone who's trying to figure out their first deal, and subscribe so you don't miss the next one.